This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
At the end of our previous section, we saw how to deal with pets, those potentially exempt transfers. We know that if you manage to live for more than 7 years having made the pet, then not only would there be no IHT payable when the pet was made, there'd be no IHT payable when the donor died either. What was potentially exempt when made became exempt. But, as will no doubt be the case in your exam question, if we die within 7 years of having made the pet, then it becomes chargeable. If there's more than one such pet, we deal with each in turn on a chronological order from the earliest first within that 7 years before death, and use up the nil rate band accordingly. As soon as the nil rate band has been used, then a 40% tax charge applies. But what we also made reference to is that if there were a tax charge in relation to a pet, i.e. we'd gone above the available nil rate band, then taper relief may apply to reduce that tax charge. But taper relief was only available if, though sadly we did die within 7 years of having made the transfer, if in fact we had managed to live for at least 3 years. So now it is in section 5 of our inheritance chapter here, chapter 24, we look at the availability of taper relief. Now the important thing to stress here about taper relief is that this is a reduction in the tax charge. The relief is applied to the tax charge. The most common mistake made by students is that they reduce the amount of the chargeable transfer, the amount of the transfer, the value of the pet there, by the taper relief. No, absolutely not. The taper relief is a reduction in the tax charge. It will only be applicable, therefore, if there is a tax charge, and equally only applicable if you, the donor, manage to survive for at least 3 years from the date of the lifetime transfer through to the date of death. As we said last time, then the taper relief moves on a proportionate basis from at its lowest level. If you manage to survive for between 3 and up to 4 years from the date of the transfer to the date of death, then the tax charge would be reduced by 20%. If you very nearly made it because you survived for between 6 to 7 years from the date of transfer to the date of death, then 80% taper relief will apply. The tax charge will be reduced by 80%. And you can see there that between those various numbers of years, we've got the relief moving in 20 percentage point terms. That table, by the way, is, as you can see there, provided in the exam. Not that you should be needing to look that up. Time is everything in the examination. We cannot afford to waste any. I'd have expected that by the time you come to the exam, you'll be very familiar with that basic taper relief table. So only available against a tax charge if there is one, and then only if you've managed to survive for at least 3, but obviously not the required 7 years for there to be no IHT charge. Let's see how this works, therefore, by looking at illustration 7. Now we go back to our favourite heroine here, D. D parted, as you will recall, and back in illustration 5, we had 2 lifetime transfers, both of £200,000 worth of chargeable transfer. But we made those so close to the date of death that there was no taper relief available. So what am I doing now? We're pushing back the boundaries. So now the dates of those 2 pets are the first in January 2010 and the second in June 2012. Remember, of course, that D sadly died on the 1st of February 16. So compute the amount of IHT payable as a result of D's death. Lifetime transfers chargeable on death. If you want to put the date of death in there as well, 1st of February 16, just to remind you what time period we're looking at. We said we would therefore wind the clock back 7 years, so from the 1st of February 16 back to the 1st of February 2009, and then list out the earliest transfer within that 7-year period and move forward from then, listing out any further transfers through to the date of death. Well, we've now made that first PET January 2010. Now remember, we went back 7 years from 1st of Feb 16 to 1st of Feb 09. So yes, January 2010 does fall within the 7 years prior to the date of death, and hence it becomes chargeable. What was the amount of the gross chargeable transfer? £200,000. It is the first such transfer now to be charged to tax, and therefore enjoys all of the nil rate band, therefore there is no tax. Now because there is no tax, then the question of taper relief is irrelevant, because remember, it would reduce any tax charge. There is no tax charge, there is therefore no taper relief. But then on to June 2012. It was £200,000. We've used up 200 of the nil rate band, that leaves 125, pushing 75,000 up into the 40% band, and there's the 30,000 tax charge as we computed again back in illustration 5. But now we've got to look at the dates. June 2012 there, compared to the date of death, the 1st of February 16. Have we survived for at least 3 years? Yes, from June 2012, 3 years on from that, would be June 2015. So we have survived for at least 3 years. Did we survive for 4 years? Well, no. 4 years on from June 2012 would be June 2016. Sadly, D died in February 16, so the death has occurred between 3 to 4 years from the date of death through to the from the lifetime transfer to the date of death. So picking up from the table up there, not that again we should need to use that table, but that means that taper relief is now available, 20%. 20% of the tax charge. The tax charge is 30,000. 20% of 30 is £6,000. Take it away, and therefore the tax payable on that PET has now been reduced down to £24,000. Taper relief has reduced the tax charge. As in illustration 5, the nil rate band has of course been fully utilised on the lifetime transfers that took place within the 7 years before death. It means therefore that the entire chargeable estate of £750 is taxed at 40%, giving again an IHT liability of £300,000. As we've referred to throughout our studies, IHT is a cumulative donor-based tax here. Now, although it's donor-based, it will in relation to a PET be the donee that has to pay any tax. It can now be seen that the amount of the tax that arises on either transfers made in lifetime or on death cannot be computed in isolation, and it's nothing to do with the circumstances of the donee. IHT is a cumulative donor-based tax. There you have got two identical £200,000 transfers, January 2010 and June 2012. On the first one, no tax to pay, because it got to use all of the nil rate band. On the second one, what started off as 30 became £24,000 of tax to pay after applying taper relief. If I'd move forward another couple of years to 2014, say, and put another £200,000 PET through at that point in time, what would that mean? Well, by then, all of the nil rate band has been used, so all of that £200,000 would be taxed at 40%. That would be £80,000. In June 14, that is within 3 years of the date of death, February 16, so there'd be no taper relief. So on that 200,000, on that 200,000, a PET taking place in 2014, maybe June 2014, there, no nil rate band available. 40% of 200 is 80,000. No taper relief available because this is within 3 years of the death of the taxpayer. So £80,000 difference in tax charge. you can now see the relevance and the importance there of the timing and the fact that IHT is a cumulative donor-based tax. That whoever received the pet in January 2010 of 200,000, though sadly their D went on to die within 7 years, suffered no tax. The June 2012 recipient suffered tax charge of 24 after taper relief had applied. And the poor old recipient of the £200,000 gift in June 2014 lost £80,000 of that in the form of a tax charge. You can see now how important the timing of these transfers is. So for example, if let's say your great aunt Beatrice, currently aged 102, got in touch with you because you're the accountant in the family and she knows you've studied tax there, and she says to you that she wants a little bit of help as regards tax, specifically inheritance tax, so invites you round to have a little discussion. And when you get there, she says to you that she wants to give you and your 4 cousins each £100,000. So there's 5 of you that she wants to give £100,000 to. She likes all of you there, isn't that nice? And wants to give you £100,000 each. We discover that she's made no previous lifetime transfers, and she wants your advice about whether or when to make these lifetime transfers, either in lifetime or just leave it until she dies and leaves then the £100,000 each to the 5 of you. So, what is your advice? I'm thinking that your advice might go something along these lines. That yes, it would be a good idea if she was able to part with that money to give it away in lifetime. We have seen the benefits of making pets rather than leaving assets within your estate that then would become fully chargeable when you die. If you give it away in lifetime and live for 7 years, what was potentially exempt when made will suffer no chargeability. If you don't live for 7 but survive for at least 3 years, then any tax charge is reduced by taper relief. None of which would be applicable if you just kept the money until you died, and all of it then in the estate, once the nil rate band has been used up, is taxed at 40%. So, we look at Aunt Beatrice. Currently 102. You got to ask the question, is she going to make it to 109? Probably no. Let's hope, but probably no. So your suggestion might be this. I tell you what, great aunt, as I'm here, you may as well give me the £100,000 now. I'll take mine now. But I tell you what, that writing of the cheques is very tiring. I'll come back in, say, a week's time, and we'll do another one, and we'll carry on like that. Now, why is it that you're so keen to get in early? The reason, of course, is that you know that should sadly Great Aunt Beatrice not survive for the next 7 years, she doesn't make 109, then that transfer will become chargeable. But if this is the first £100,000 gift that she made, which it would be within the 7 years before death, then there would be no IHT to pay because it would all be within the nil rate band. So there'd be no tax to pay. There'd equally be no tax to pay on the 2nd and 3rd transfer. So those 2 cousins that you like, they can have number 2 and number 3 gifts there. And they too need not worry about any tax payable. But then there's the couple of cousins you've not liked. One rather more you dislike than the other. So the other one, he can have the 4th, let's say, transfer. So when sadly Great Aunt Beatrice dies, that 4th transfer will only benefit from £25,000 of nil rate band, leaving £75,000 chargeable at 40%, and that, I think, if we do that in our heads, will be £30,000. And the 5th and final transfer, 100,000, no nil rate band, fully taxed at 40%, £40,000 tax. how nice it will be when you speak to these people after, sadly, Great Aunt Beatrice has gone, and they ask the question about, so, how much tax did you have to pay then on your gift that she kindly gave to us? And you can then say, nothing. Thank you very much. You might make various signs with your fingers at this particular point in time, but nothing indeed there, because your gift enjoyed the use of the nil rate band. Sadly, theirs did not get full or any use of the nil rate band, and they were going to have to pay out £40,000 tax. Suddenly all those things they'd said about you being a boring accountant, well, suddenly it's paid off, and maybe you're not as boring as they thought. So there, the timing of those transfers is all important. Again, get in early would be the advice in terms of any lifetime gifts. But again, look through the example as we see it there to see how it is that we apply the nil rate band, and how and where, if it is applicable, we apply taper relief. Remember, taper relief only reduces tax charges. Do not put it against the value of the transfer, the chargeable transfer. It goes against any tax charge. All right. Now, we said that there were two types of lifetime transfer where tax charges may arise. There were three types of transfer in total, but one of them, transfers to spouses or civil partners, were exempt. So therefore there would be no tax charge either in lifetime or when you die. But other than pets, there were then CLTs, chargeable lifetime transfers. Now these are probably the more difficult to deal with. This is going to cause us a little bit more trouble than maybe what we have seen so far, and therefore we'll need to focus our attention carefully. Chargeable lifetime transfers, CLTs, as we will now refer to them as. Now we know what a CLT is. It's a transfer made in lifetime into a trust. A chargeable lifetime transfer, a transfer into a trust. Now with a CLT, IHT is chargeable at the date of the gift. It is a chargeable lifetime transfer, unlike a pet. And because it's chargeable when made, we will use the nil rate band in force at that date, when the transfer was made. As again we said in, I think, a previous session, if the taxpayer made a transfer into a trust in 2004, then the only nil rate band you could have used and the only tax rates you could have used were the ones in force at that date. So for transfers made before 1516, the relevant nil rate band limit will be provided for you. That will be given by the examiner on your rates and allowances page. You will be provided with that information, or indeed within the question itself. As we also said, since about 0910 we've had the same 325,000, so possibility that you might only have to deal with that. But you go back any further than that and the nil rate band was lower. But if it were lower, then you will be provided with that figure. Now, when they give you the nil rate bands for earlier years, this is relevant only for CLTs, but they will lay a trap. They will give you sufficient rope by which to hang yourself. What they will do is to give you the nil rate band in force at the time a pet was made, maybe back in the mid-2000s. Now that is entirely irrelevant. A pet was not chargeable when made, and of course would only be chargeable if you died within 7 years of having made it. And if you did die within 7 years of having made it, it becomes chargeable on death. And when you calculate the tax on death, well, we use then the nil rate band in force at the date of death. So these earlier nil rate bands are only relevant for CLTs and only relevant when computing the amount of lifetime tax that is payable. Now then, if IHT is payable, it should be paid 6 months, we've seen that before in relation to a due date, 6 months after the end of the month in which the transfer was made, but earliest is the 30th of April following the end of the tax year. So if you made a transfer early in the tax year, in May, June, July for example, 6 months after that would place that date still before the following 30th of April. So it would then be the 30th of April following the end of the tax year. So for example, tax payable on a CLT made in December 15, 6 months after the end of December would be the 30th of June 16. That is after the 30th of April 16, therefore you'll use that as the date. Whereas if the CLT was made in June 15, then 6 months on from the end of June 15 would be the end of December 15, but that would mean it would not be payable until April the 30th, 2016. Now, we said we're going to use a lifetime rate. Now, the gross rate, notice I use here the term gross rate of IHT on transfers, above the nil rate band is 20%. So again, as we've been seeing with pets, you firstly apply the nil rate band, and only if the value of that chargeable transfer for the CLT exceeds the then available nil rate band is there then a tax charge on the remainder. And the gross rate of that tax charge is 20% and is applied if the tax is being paid by the donee. Now, the donee in relation to a trust will be the trustees of the trust. It's not their money. The trustees control the finances of that trust, and if there is tax to pay, the money will come out of the trust fund and be paid over to HMRC accordingly. So the trustees will pay it. It will be borne by the trust fund because the money will be taken out of the trust fund. There will be less in the trust fund as a result. Now, that type of transfer, pardon me, i.e. where the trustees, the donee, the trustees of the trust, pay any tax due, that is known as a gross transfer. But the trustees will only pay if the donor says, the settlor, the donor, the person who puts the money into the trusts, says to the trustees, here is, let's say, a whole load of cash. If there is any tax to pay, okay guys, you pay it out of the money I put into the trust. But what might happen, and frequently does in exam questions, and you'd assume has happened, unless you are told that the trustees elected to pay the tax, is that if the trustees don't pay, the only person left to pay is the donor. So if the tax is paid by the donor, the transfer is said to be, well, if the trustees paid, it was a gross transfer, If the donor pays, it's said to be a net transfer. And the gift has to be grossed up as the IHT payable by the donor effectively becomes a part of the gift. Now, the easy way of doing this is to apply a net rate of IHT, one of 25%, to any part of the net gift that exceeds the available nil rate band. Now, whether it's gross or whether it's net is entirely irrelevant until you go above the nil rate band. While you're in the nil rate band, there is no tax. Nobody's paying any tax, not the donor, not the donee. There is no gross or net. So only when any part of any CLT exceeds the then available nil rate band will there be a tax charge. It is then that we need to answer the question, who pays the tax? If you're told, as you must be told, that the trustees are paying the tax, then you apply a 20% tax charge to that figure, the excess of the transfer above the nil rate band. If you are not told anything, or you are very specifically told that the donor pays, then to the excess above the available nil rate band, you apply a 25% rate. The gross amount of this transfer is then computed by adding the amount of IHT to the net transfer. Right, a bit to take in there. But let's see how very simply we deal with that in relation to a couple of illustrations. Firstly, illustration 8 now. We get introduced to our new heroine, K-Bab. It's a strange name. Work it out. This is a donor-based tax. A donor-based tax. K-Bab. Now, if you've never heard of a donor K-Bab, this is not very funny. Even if you have heard of a donor K-Bab, it's still not very funny. But it's my example. K-Bab made a chargeable transfer into trust of £400,000 in June 2011. Transfer into trust, that is a CLT. She has made no previous lifetime transfers, and the nil rate band in 1112, well, we know this, was the still relevant £325,000 worth of nil rate band. Compute the amount of IHT payable, assuming firstly the trustees paid any IHT due, then that K paid any IHT due. Now remember, if the trustees pay, the donees, the trustees pay, what type of transfer is it? It is a gross transfer. If the donor, here K, pays, it is a net transfer. Right, we now need a new computation headed lifetime transfers chargeable when made. We saw that on death we had a computation headed lifetime transfers chargeable on death. This one for CLTs in lifetime, lifetime transfers chargeable when made. Right. We'll now see that we use 3 columns. We still have our gross transfers column and our tax column, our IHT. And this time we've got also a little inside working column there in which we record the value of the chargeable transfer. So, we'd also, by the way, record the date if there was more than one of them. This would be June 2011, so we'd have June 2011, CLT. What is the CLT? It's £400,000. That goes in your working column there. Right, we then have to tax it. Do we go above the nil rate band? Yes. 325, there were no previous lifetime transfers, enjoys the full use of the nil rate band. But it now pushes £75,000 out of the nil rate band. So assuming firstly that the trustees paid any IHT due, the trustees pay, that makes it a gross transfer. If it is a gross transfer, the tax charge is 20%. 75,000 at 20% is 15,000. Put the tax in your tax column, £15,000. What type of transfer was this 400,000? It is a gross transfer, so the 400,000 goes into your gross column. The 400,000 is the gross figure. Nice and easy. To repeat, what available nil rate band at the time of transfer? £325,000. How do we deal with that? 325 at nil, 75,000 at. Well, now we're above the nil rate band. Who is paying the tax charge? As it's the trustees, it's a gross transfer, therefore 20%. 20% is 15,000 into your tax, your IHT column, and the self-same 400 is the gross transfer. Put it in your gross column. If, on the other hand, you'd been told that the donor paid the tax, K paid the tax, or indeed that the question was entirely silent over who paid the tax, you would then assume that the donor paid. So if K paid the tax, yet again, the first 325,000 is still within the nil rate band, and that is therefore nil. But now the 75,000 would be taxed at 25%. So in this calculation here, it would now read 75,000 at 25%. So 75,000, this again is the same June 2011 CLT, 75,000 at 25%. We put the 400,000 into our working column, the tax charge 18,750 into the tax column, and then because the transfer is now said to be a net transfer, add the tax to that transfer, and there's your gross figure. So have a little look at that or those calculations before we go any further to make sure you're happy with where we've got those figures from. Now, remember what we've said about the nature of this tax. IHT is a cumulative donor-based tax. So where there was more than one pet that became chargeable on death, then the nil rate band was applied chronologically, and the earliest of those transfers enjoyed the first access to the nil rate band, pushing later transfers potentially out of the nil rate band and up into then the 40% tax rate charge. Well, so it is that in lifetime, when dealing with CLTs, again we work on a cumulative basis, but only on a cumulative period of 7 years. We still use this 7-year period. Same idea that when you die, you only wind the clock back and tax those transfers that occurred within the 7 years before death. Now, when dealing with CLTs, we work purely on a 7-year rolling cycle. So, as a CLT is immediately chargeable to IHT, as we have just seen, it goes into the donor's IHT accumulation, using up his nil band for the next 7 years. So because it's a cumulative donor-based tax, any CLT you make now is going to be around in terms of impacting on any available nil rate band for future CLTs for the next 7 years. So looking at what was just happened here in the illustration 8, in June 2011, we used up all of the available nil rate band. If therefore there was another CLT within 7 years, June 11 on to add 7 years, June 18, and the nil rate band remained at £325,000, or at least below 400,000, the lowest figure that the gross transfers could be there, depending on whether it was gross or whether it was a net transfer. If another transfer came along within that 7-year period and without such an increase in the nil rate band, then you would already be deemed to have used the available nil rate band in June 2011, meaning that the next CLT would be fully taxable, be it at 20% or be it at 25%, depending on who pays the tax. It might therefore be a sensible thing to do if you wanted at a later point to put, if K wished to put more money into this trust, to wait for 7 years, because after 7 years the June 11 transfer would cease to have a cumulative effect. So if you waited therefore from June 11 to say July 2018, more than 7 years later, and then made a transfer of 325,000, let's assume the same nil rate band as now still then applies, makes a transfer of 325, then winding the clock back 7 years from July 18, there would be no CLTs made within the 7 years before that, and therefore a full and the then available 325 nil rate band would be applicable, meaning none of that transfer would suffer any lifetime tax. So this nil rate band effectively renews itself in relation to CLTs on a 7-year cycle. The cumulative impact of CLTs is only felt over a 7-year period. It's that aspect that usually gives most of the problems so far as these computations are concerned for students studying IHT. So, as a CLT is immediately chargeable to IHT, it goes into the donor's IHT accumulation, using up his nil band for the next 7 years. If the donor dies within 7 years of a CLT, additional tax may be due on top of the lifetime tax paid. The IHT liability is calculated in the same way as the tax on a pet there, and again with credit relief given for taper relief there, based on any lifetime tax that was paid, and also will deduct any lifetime tax paid, in calculating any additional tax due on death, all of which is to come in the next illustration. But again, just to make that 7-year accumulation point, that if you carried on, you survived for at least 7 years, then the impact of the CLT would cease to have relevance for your IHT computations. The cumulative nature of this would then have gone. If you had made another CLT within, in illustration 8, 7 years of June 11, so you were silly enough to make it, say, in June 17, therefore just 6 years further on, then any amount, assuming the nil rate band is still 325, any amount and all of that transfer would be fully taxable, be it, as we said, at 20 or 25%. If you'd waited until July of 2018, more than 7 years, then the old gross transfer total on this lifetime transfers chargeable when made computation, it would now have run its 7-year cycle and would have been removed from this computation. You could go again with the then available nil rate band. But what we're suggesting now here in relation to illustration 9 is that what happens if you die within 7 years of it. We see that while you're alive, you pay tax at the lifetime rate. But if you die within 7 years of having made the CLT, then further additional tax charge may become due. Now, don't immediately panic here about, well, that's not fair, double charge the tax. The worst that can happen is you now end up paying as much tax as you would have done had it been a pet, for we will credit back any lifetime tax that was paid. We will credit any taper relief as well, such as we will see in this example now. Now remember that K made a chargeable transfer of 400,000 into the trust in June 11. Sadly, K then died in December 15, leaving a chargeable estate of £1 million. Requirement: compute the IHT payable as a result of K's death, assuming that the trustees paid the tax payable in lifetime as shown in illustration 8. So remember, if the trustees paid, that made it a gross transfer. Right. Lifetime transfers chargeable on death. We've already done the lifetime transfers chargeable when made. If I take you back to that, where it was a gross transfer, let's just get rid of all of those lines there, those notes, there we go. It was that working that would be relevant. Lifetime transfers chargeable when made. That would be the first computation you'd prepare. Now, sadly, K has died within 7 years. She died December 2015. The transfer June 11. Two things relevant here to begin with. Did she survive for more than 7 years? No. Therefore, the June 11 CLT will become chargeable on death as K died within 7 years. Did she die within 3 years of the date of the lifetime gift? No. June 11, she survived to December 15. She survived for more than 3, but of course not the required 7 years to remove any further tax charge from being payable. So what it means is that in relation to the tax charge, taper relief will be available. Right. We've done, as we said, the lifetime transfers chargeable when made. Now the computation, lifetime transfers chargeable on death. There is but the one, the June 11 CLT. What was the gross transfer? Look back to the previous computation. It was £400,000. Into your gross column it goes. Remember, we're now dealing with chargeable on death, so we only need these two columns, gross transfers and IHT. We apply the nil rate band applicable at the date of death. This is a separate IHT computation. This is lifetime transfers chargeable on death. We apply using the nil rate band chronologically, first come, first serve. the nil rate band that existed at the date of death. It happened also to be 325. When dealing back in illustration 8 with the tax payable in lifetime, we use the nil rate band in force at the date of the lifetime transfer. So this is back to as we were dealing with transfers, pets, made within the 7 years before death. So earliest one, the only one, June 11. What is it? It's a CLT. How much is it? 400,000. Tax accordingly. 325 at nil, 75,000 at 40%, 30,000 into your tax column. But that tax charge is now available to be reduced. Firstly, for the same reason as we reduced the tax charge on pets. Pets that only became chargeable on death, but where you'd survive for between 3 to 7 years, taper relief applied. So what have we got here? June 11. Right. 3 years on would be June 14, yet survive for that. 4 years on, June 15, yet still alive. But died before June 16 came around, died in December 15, so survive for between 4 to 5 years. Look it up if you need to on the table provided. That's 40% taper relief, which is now deducted. 40% of 30,000 is 12, bringing you down to 18,000. It is at that point, following the usual deduction for taper relief, that then you deduct the amount of any lifetime tax that was paid. What was that lifetime tax paid? Back we go. It was £15,000. Therefore, take away your 15,000, and that leaves you with additional tax now due as a result of the tax donor's death, D's death. See, hang on a minute, I'll get it right a moment. K's death here. Additional tax due upon her death of £3,000. Now, that additional tax is payable in relation to the trust, so it will be paid by the trustees. They are the people who will pay it, but the money comes out of the trust, so it would be said to be borne by the beneficiaries. So it's paid by the trustees, it's borne by the beneficiaries of the trust. There is now less money left within the trust to be used by the beneficiaries. So the additional tax due on death, £3,000. Note that in relation to the lifetime tax paid, that if the lifetime tax paid exceeded the amount of tax now due, i.e. it was more than £18,000, then of course there would be no additional tax payable. But equally, there would be no repayment of any lifetime tax paid. You paid the relevant amount of lifetime tax, that's it, job done, we're never going to go back and get any of that returned to us. So the best you can hope for here is that if the lifetime tax paid is as big or bigger than the amount of tax remaining after taper relief has been applied, then that would bring down the additional tax due on death there to nil. That's as good as it can get. Right. Take time out now, please, to go through, check it again, the examples, these illustration 8 and 9. Make sure you're happy with what we've done and what we have said. So pause now, please. Okay, now just to summarize the last exercise that we've done there in terms of illustration 9. What we've discovered is that in lifetime there was a transfer into a trust. Therefore, we labelled it CLT. At the date of the transfer, what was the nil rate band? It was less than the gross amount of that transfer. So we had to do a computation of tax that was headed lifetime transfers chargeable when made. This calculation needed to be done. That was the first computation to prepare. Lifetime transfers chargeable when made. Now, depending on who paid the lifetime tax, we'd either have this result, as we've then used in illustration 9, or if the donor, if K had paid it, we'd have had that result in terms of the lifetime transfer. But having computed the lifetime tax, then what do we see? Sadly, the donor did not survive for 7 years. Sadly, the donor, here K, died within 7 years. That therefore meant that we were now going to have to do a calculation of tax on lifetime transfers chargeable on death. What would this bring in? It would bring in any and all pets as well as CLTs that had occurred within the 7 years before the date of death. Here there was but one, it was the CLT. Bring in the gross amount of that transfer, here it was 400,000. If the transfer in lifetime had been a net transfer, there, top of the page, is what the gross figure would be, and that is what you would now be including here. The gross figure is what you include in this computation. We now use, as we always do on death, the nil rate band in force at the date of death. As there was only one lifetime transfer, 325, it enjoys all of that nil rate band and the balance of 75,000 at the tax rate in force at the date of death, 40%. That is £30,000 of tax. We then are able to reduce that tax charge in relation to either or both of two possible deductions. The first, as is also applicable for pets, taper relief, only available if, as here, the lifetime transfer occurred more than 3 years prior to the date of death of the taxpayer. Sadly, we didn't, of course, last for 7 years, in which case none of this would have been chargeable on death anyway. But died within 7, managed to survive for more than 3, so taper relief applied. Then we would deduct the amount of lifetime tax that was paid, subject to computing a lowest figure of additional tax due on death of nil. We cannot turn that into a repayment. That would be the second computation, lifetime transfers chargeable on death. And then, of course, there is a third computation, chargeable estate. So you would then put together, now here of course you've been told what the chargeable estate was. You may have been told that K died in December 2015, owning the following assets and owing the following sums. You listed those assets out, you took out any liabilities due at the date of death, you took out any reasonable funeral expenses, and then proceeded to calculate the tax on the chargeable estate. How would we do that? Is there any nil rate band left to go against the death estate? Answer, no. Lifetime transfers chargeable on death have used up all of the nil rate band, meaning that now, if you were showing the computation for the chargeable estate, it's £1 million, and all of that 1 million would be at 40%. So the tax on the chargeable estate, a nice round, though nice is probably not the word we would use in this circumstance, but £400,000 of tax would be payable on that chargeable estate of £1 million. So there are your three computations. Lifetime transfers chargeable when made, dealing only with CLTs. Lifetime transfers chargeable on death, dealing with both pets and CLTs that were made within the 7 years before the date of death. They now become chargeable on death. And the third one, the chargeable estate at death. Again, that listing exercise of the assets held, less any debts and liabilities due at the date of death there, and of course less any reasonable funeral expenses. In terms of the lifetime transfers, the figures that we have included, we have referred to as chargeable transfers. Back in our first lecture, we calculated a transfer of value that became the basis of computing the chargeable transfer. But as we will discover in our next lecture together, that there are certain exemptions that may serve to reduce the transfer of value down to the figure of chargeable transfer. And it is that figure that would now be picked up in the computations that you see here. It is the chargeable transfer that would be included here, the £400,000. The chargeable transfer. These figures going into the IHT computations are based on the chargeable transfer figure. So how we get it is going to be the result of another and primary first working that you do to compute from the transfers of value on your lifetime transfers made the figures of chargeable transfer. Only once you have them may you then feed those transfers into the relevant IHT computation or computations. CLTs, both lifetime transfers chargeable when made and lifetime transfers chargeable on death computations. PET, only going into, only relevant for the lifetime transfers chargeable on death. So understand where these transfers go in terms of the computations for IHT, either done in lifetime or then also done on death. Revise through, please, and then we'll go into and deal with those exemptions in moving from transfer of value down to chargeable transfer in our next session together.